International transactions is also for level 2 only. International transactions are governed in terms of Section 31. Section 31 applies to any affected transaction that leads to a tax benefit to any party to the transaction. So there are some definitions that we need to have a look at. One being an affected transaction. An affected transaction is a transaction that is between connected persons or associated enterprises under conditions other than arm's length conditions. So there must be connected persons and the conditions are non-arm's length. So what is connected persons? Well, when it comes to connected persons for financial assistance, connected persons is 20% of the equity or voting rights. However, if it is an affected transaction where it is transfer pricing, then 20% is only enough if nobody has the majority of voting rights. Here are some examples of some connected persons and cross-border transactions. If we go and we have a look at that definition in terms of Section 31 for connected persons, it's important to note that this definition only applies where there is financial assistance, something that may have been referred to as thin capitalization in the past. So where there is this financial assistance, a connected person could be a company that holds 20% of the equity shares, whereas under Section 1, a connected person will only qualify with 20% if nobody else has the majority, whereas under Section 31 for financial assistance, 20%, even if there's another company that has a majority, will be enough to make them connected persons. Just remember, a company that holds 20% will qualify as a connected person for Section 31 financial assistance, not for transfer pricing, regardless of whether another company holds the majority voting rights. So here's an example to explain it. If we have foreign company 1 holding 20% in SA company 3, and then foreign company 2 holds 80% in SA company 3, in terms of Section 1, only foreign company 2 will be a connected person because 20% doesn't count if there is a majority. In terms of Section 31 for financial assistance, both foreign company 1 and foreign company 2 will both be seen as connected persons because 20% is sufficient even if there's another company that holds the majority shares. So that's the affected transaction and connected persons for Section 31 financial assistance. In order for it to apply, there must have been an affected transaction and a tax benefit, and we will calculate the tax benefit by applying arm's length conditions. If there is a difference, the difference in taxable income, if it's a resident, the company is deemed to have distributed an asset in specie, so thus a dividend in specie. If the resident, so if there's a resident company, which was the only way it's going to work for an international transaction, there must be a resident and a non-resident. The other company, for anyone other than a company, so like a natural person, then it would be seen as a donation. When does this dividend and this donation, when is it deemed to have occurred? It's deemed to have occurred on the last day of 6-month period following the end of the year of assessment. So if my year of assessment is 31 December, then it is deemed that this dividend in specie or donation occurred on the 30th of June. International transactions transfer pricing. Are the parties resident and non-resident and connected in terms of Section 1? If the answer is yes, we need to then ask ourselves, has a tax benefit arisen? If the answer is yes, we then need to go and only allow the South African company to deduct or include an amount equal to an amount under an arm's length transaction in terms of section 31(2). And the difference between the actual amount and the amount charged or paid will be either a donation if it's a natural person, or deemed to be an asset in specie, a dividend in specie, if it is a company. And it is deemed the donation or the dividend in specie occurs 6 months after year end. In this example, we have Turkey, a resident, selling trading stock with a cost price of 150,000 to a non-resident connected party, Goose PLC, for 180,000, but the market value is actually 250,000. Goose is managed and controlled in a country with a 15% tax rate. So we need to decide, do we have an affected transaction? Well, firstly, do we have connected parties? Yes, we're told they're connected parties. Secondly, is there a tax benefit? Well, yes. Goose is in a country that only has a 15% tax rate. Therefore, if they pay only 180,000 for something that's worth 250,000, that difference in the profit would then obviously be taxed at a lower rate. Therefore, there is a tax benefit. The year end is December. How do we account for the adjustment? Well, firstly, we would have had gross income from the sale, the 180,000 that was charged to Goose. Then we need to go and make an adjustment to what would it have been as if it was an arm's length price, and therefore we have the 70,000 that we have to add, being the difference between the market value and what we sold it to the connected person for. We would have a deduction for the opening stock, what it cost us to make or buy the stock, resulting in a taxable income of 100,000, which is what it would have been had this been an arm's length transaction. However, because section 31 applies, that difference, that 70,000 will be a dividend in specie and will be subject to 20%. That dividend in specie will be deemed to have occurred. Remember, we said December was the year end, on the 30th of June. Therefore, it should be paid by no later than the 31st of July, the following year. So that was transfer pricing. If we have a look at financial assistance, we have an affected transaction, can also be where there's this financial assistance provided between a resident and a non-resident connected persons. It could be where there is low or high interest rates levied or paid, or there is excessive financial assistance given, more than what you would have been able to get at a local bank. Financial assistance would include debt security or a guarantee. How do we decide whether section 31 applies? Well, are the parties connected? But here we need to look at the connected persons rule in terms of section 31, which, remember, 20% is sufficient to be seen as a connected person, even if another company has the majority of the voting rights or shares. So if it is connected persons, then we need to go and ask ourselves, has a tax benefit arisen? We need to go and only allow the company to deduct an amount equal to an arm's length rate of interest, only allow the deductible interest to be based on amount that would have been in an arm's length lender. Okay, it could be one or the other, or it could be both. And the difference, again, is going to either be a donation if it's a natural person, or a dividend in specie if it is not a natural person. Again, it is deemed to have occurred 6 months following the end of the year of assessment. And then obviously the donations tax or the dividends tax is payable the month following that. If we have a look at this example on financial assistance, we have on the 1st of January year 1, Turkey, a resident company, so we need a resident, received a loan of $1 million at 20% interest per annum from Goose, a non-resident company that holds 21% of the shares in Turkey. So do we have a connected person or not? Well, if this is financial assistance, remember 20% is sufficient. The other shares, 79% in Turkey, are held by Chicken. So even though another company holds the majority of the shares, because this is financial assistance, the 21% in Turkey is sufficient for them to be seen as a connected person. Turkey could only qualify for a loan of $600,000 at 15% per annum at the local bank. Turkey has a December year end. What's the impact of this? Well, as we've mentioned in terms of Section 1, Turkey would and Goose would not have been connected persons. But in terms of Section 31, and this is financial assistance, they are seen as connected persons because 21% would be sufficient. If we have a look at the interest that was incurred in year 1, there was R1 million at 20%. We remember we need an affected transaction, so we've got the fact that we've got a resident and a non-resident, they're connected persons. What is the benefit or the tax benefit? Well, if there's a company with a high tax in a high tax rate country versus a low tax rate country, there's going to be a taxable benefit there if you move the income to the country with the lower tax rate. So when we look at the interest that is incurred, Turkey will have paid 200,000 rands interest and would want the deduction for that. However, because financial assistance and Section 31 applies, we are going to limit the amount that Turkey can actually get as a deduction. Now remember, the first limitation was on the interest. It needed to be at an interest that they would have, an arm's length interest, and the amount of the loan also needs to be an arm's length amount of the loan. We were told that the reasonable amount of a loan and interest would have been 600,000 at 15%. So the easiest way to do the calculation would be to take an arm's length loan amount times an arm's length interest amount, and that would be the allowable interest that can be deducted for income tax purposes. The difference between the interest incurred of 200,000 and the amount that is allowable, 90,000, that 110,000 difference is seen as excessive interest and will be deemed to be a dividend in specie. Dividends tax is payable on the 31st of July in year 2 because it is deemed that this dividend in specie was effective at the end of June, therefore it is payable end of July.